Well, you talk about India. Last week, India's largest precious metals refinery, um, they ran out of metal ahead of, how do you pronounce it,
It's
Diwali?
either
Uh,
Diwali or Diwali. It's the festival of lights, and I apologize to
yeah, I
anyone
mean,
for not getting that right. I believe it's either Diwali or Diwali.
and at the same time, you're watching massive stress in London. There are reports that there's genuine stress for silver, lack of silver in China, that the supply chain has completely been dried. For the first time in 50 plus years, central banks not only are buying gold, they're buying silver too. We saw Saudi central bank purchase almost 30 million worth of SLV in August. As much as I almost choke on saying that, SLV, the amount that they bought would allow them to take possession. And then you get reports that foreign investors now hold a higher amount of gold than U.S. Treasuries.
Gold is trading above $4,100 per ounce. Silver sits near $48 after a recent correction. And according to Andy Schectman, this isn't a breakdown. It's the quiet before the storm. He says the London Bullion Market Association quietly told China, "We'll take it all, even at 30% lease rates. We need silver, right now." That one message reveals the depth of the urgent demand and collapsing availability in the physical silver market. Meanwhile, India's largest refinery reportedly ran out of silver ahead of Diwali. Lease rates have spiked, and central banks are actively adding silver alongside gold for the first time in decades. So tonight, we'll unpack Andy Schectman's warning, why the world's largest bullion banks are in panic mode, how the pricing system for gold and silver is shifting eastwards, and why you, as an investor, need to prepare for what comes next.
In fact, the share of U.S. Treasuries, they were saying, was down by foreign investors from 49% to 31% today. 49% in 2013 or 2012, somewhere in that neighborhood. But in other words, at the same time all of this stuff is happening, you're beginning to see real stress within the banking system, where we've seen these two big the auto supply and the other company, I think it was called Tricolor Subprime Auto Lender, and you know the private equity in dealing with some prime auto lenders. This company just went belly up and is tied to the regional banks. And you got Jamie Dimon, who comes out and says, this is like a cockroach, where you find one, there's lots more of them. You have the head of the IMF, Kristalina Georgieva, I think is her name. She said this keeps her up at night. And then you see the banks in the repo market. All of a sudden, you have repo market where you're seeing banks starting to pledge, instead of treasuries, they're pledging their toxic assets like mortgage-backed securities, because the banks are stressing because of all the problems in the commercial real estate market. The banks are in trouble again, and you can see that by looking at the repo market, what's happening. So you have all of these things happening at the same time. Government shutdown, stress with the regional banks, private equity starting to fail, which puts more stress on the banks, on top of all of the things that we've talked about. And I think gold up for 9 straight weeks, I think, was starting to perhaps make some of the people, these large banks who hold these large positions, very nervous. And it's a coordinated attack. Who did it? Why they did it? What is the motivation? All of that stuff we may never know. All I can simply tell you is that the mainstream who comes and says all of this stuff, this is the same crap they've been saying all along, as gold and silver have outperformed everything since you and I did our first interview 3-4 years ago. And they said the same thing every single time. It was the same thing. Yet here they are continually revising their estimates. And when you see guys like Jeffrey Gundlach, who made his living selling bonds, come out a few weeks ago and say, 25% allocation to gold is not too much. This is a guy that is the bond king. When you see Michael Hartnett say 25% gold, or the CIO of Morgan Stanley say 20% gold, or Jeff, the head trader at Jefferies, say the next stop for gold is 6,600, you're seeing people at very, very, very high levels talking about this. You're seeing massive deliveries coming into COMEX, and you're seeing all of these things happen at once. There are some people who are scared because there are people that are over leveraged and with an inability to access metal. And in London, it's a T+1 settlement. We've been told all year it's anywhere from 4 to 8 weeks delivery. There are stresses and strains, and it's a battle between the paper and the physical market. Who's behind it? What are the motivations? That's something I don't know. I can only guess and I can only speculate. But the more I hear of the mainstream narrative, the more I want to vomit. Because, yeah, a lot of it is true. But if it were true, you have to then talk about how it was resolved. And these things are not how they would be resolved. The way that it happened is not how it would be resolved. And so I don't think it's just normal market behavior. It's anything but. It's desperation manifesting itself in a drive-by shooting to create a perception of reality for whatever reason, to throw people off the scent. It's misdirection at its greatest level. And it's the same thing we've seen all along. And if you've been doing this as long as I have, a $250 drop in gold, yeah, it makes you want to puke, but it doesn't get you scared. It tells you you're getting closer to the point where the physical demand overwhelms the ability of these paper charades, these paper drubbings that we haven't seen for quite some time, to be honest with you. But here it is again, and this one really reeks of desperation, as you can see by it happening one in only 240,000 days in a normal market. Michael Lynch says Barclays sold 1,969 contracts, RBC customers 1,076, and Scotia House account 2,024. And, could it be profit taking from earlier buys? Maybe. But at 100 ounces a piece, when you're talking 2, 3, 5,000, 6,000 contracts, that's an awful lot of gold being dumped. We don't know who and why they would do it specifically, but he is saying it's the banks that are not the U.S. banks. Barclays, RBC, and Scotia are the ones that he points to, and he has all sorts of empirical data.
He has the evidence.
Yeah, you can go and take a look at his Substack. He publishes what he believes is the data and the footprints, the fingerprints to who sold. And I don't think it's just them. But again, it's like pushing a rock down a hill. And once it starts to move, it starts to, like a rolling stone, it starts, or a snowball starts to get bigger and bigger and bigger. It's getting bigger because it's triggering stops along the way. There were a lot of people that sold into this rally who would have probably hoped into this drubbing, that probably hoped they never would have had to have those stops triggered. But I think that's what happened in the middle of the night when you saw such a massive drop at a period of time when there was no liquidity, which just dropped the price. And then all of the triggers that would then automatically hit to sell to protect these funds from getting killed would only add to the drop. And then you had the value buyers come in and push it right back up. That's too coordinated to be coincidental, and too stupid to be stupid. No, I mean, yes and no. I mean, I don't think it's realistic to expect it to go straight up.
Sure.
But I think that from a standpoint of where it is ultimately going, I think it's going to continue to go higher. The bull wants to take as few people along for the ride as possible, Michelle. That I do believe. And so, I think that ultimately the markets will have their way. But again, you have a lot of very big players who are on the wrong side of this, massively short. Bob Coleman was talking the other day of the managed money being short 1 billion ounces of silver. In essence. And, that's massive. It's huge. So that means that there are other players on the other side of that would benefit from it. But, when you have that kind of volume on a system that is rehypothecating and trading contracts where, for example, you look at David Jensen, who's going to come on our show, he talks about 140 million ounce float in London that's trading 600 million ounces a day in deliverable contracts, with as much as 2 billion ounces in contracts out there that could stand for delivery with only 140 million ounce float. Now, what could possibly go wrong? What could possibly go wrong? And maybe that's why Eric Young is saying that the LBMA reached out to China and said, we'll take it at these obscene rates. We need it now. We need it. And we'll pay the high lease rates because of that. Because when you play a game, and look, it's not just silver collapsing. If there was a major delivery failure by one of these banks in London, as an example, all of these banks are not just involved in bullion. They're involved in every single asset that could be traded across the globe. The systemic contagion of this would be catastrophic. It would bring down some of the biggest banks in the world. And this starts to move towards what Tom Longo talks about, on a coordinated attack against the Bank of England and the European aristocrats. And I don't know that to be true. Tom believes it. But all I can simply tell you is that
Andy Schectman believes the current pullback isn't weakness. It's a deliberate shakeout in a market that's running out of real silver. In India, demand surged so violently that the nation's largest refinery completely ran dry. In London, supposed T+1 settlement is now taking 4 to 8 weeks, a glaring sign of physical scarcity. Meanwhile, foreign investors are dumping U.S. treasuries. Holdings have fallen from 49% a decade ago to roughly 31% today, while reallocating into gold, silver, and commodities. Inside the financial system, stress is everywhere. The repo market shows banks pledging mortgage-backed securities instead of treasuries for cash. Jamie Dimon warns that what we're seeing is just the first cockroach, and IMF Chief Kristalina Georgieva admits the situation keeps her up at night. Even traditional bond titans, Jeffrey Gundlach, Michael Hartnett, and others, now advocate 20 to 25% allocations to gold, a historic shift away from fiat trust. Schectman highlights one chilling metric. Managed money traders are short 1 billion ounces of silver, while London's deliverable supply is just approximately 140 million ounces. That's a 7-to-1 paper-to-metal imbalance, and London trades 600 million ounces a day on paper. If a single bank fails to deliver, he says, the fallout could detonate across derivatives, equities, and credit markets worldwide. That's why the LBMA's plea to China, offering 30% lease rates, reveals how close they are to losing control. Schectman believes coordinated paper sell-offs, like the recent price crash, are not random. They're tactical moves to force weak hands out and let major players accumulate physical metal cheap. At the same time, Shanghai, Singapore, Dubai, and Moscow are building new cash-settled, physically backed exchanges, shifting the power of price discovery from west to east. For Schectman, that's the beginning of a new monetary order, where real metal sets the price, not paper contracts.
To me, the fact that it was done the way that it is done, and then you had someone come in and scoop things up, pushing silver right back up into the positive territory, tells me it was coordinated. It was coordinated by players, perhaps, to drive the paper price down, to accumulate physical at much lower rates, to make good on short contracts that were getting very close to, creating this huge squeeze that everyone has been waiting for forever. Could it be that? Yeah, why not? Sure, there is some legitimacy to profit taking, to look, it's gone up too far too fast, and technicals say you should take profit. Some of that is true, and I believe that to be true. But that's cover for a bigger story as far as I'm concerned, and I think that's really what I take away from all of this, honestly. And I think it's hard to ignore it any other way. There are no free markets anymore, Michelle, just manipulations. But you can see the movement of these assets, these commodities, largely moving to the global south and east. And the exchanges that are popping up in places like Singapore, Shanghai, Dubai, Moscow, St. Petersburg, the BRICS facility that they're building, these will be the price setting mechanisms that will take over for the LBMA and the COMEX. Maybe not the COMEX if President Trump has something in store. Hopefully he does. But I would argue that the Western system of pricing commodities is coming to an end. And certainly those that are rehypothecated the way that they are. You look at those exchanges across the globe, they're largely cash and carry, pay, receive. The ability to, and I'll bring you back to 2020 in the middle of the pandemic, oil went to -40 a barrel. Now, how the hell does that happen? How does oil go to -40 a barrel? we'll pay you to take the oil. Well, the point of it is that when the futures market is the tail wagging the dog, setting the price for the underlying commodity, you have a problem. It should be the commodity that sets the price for the futures, not the other way around. And I think the world is growing tired of the way that the West has been able to control the commodity complex for all of these years. And that's why I've always talked about the fact that the challengers in the BRICS nations, and you look at who are the ones buying all the gold and silver. Well, it's China, it's India, it's Saudi Arabia, it's Russia, and we know this. We don't know exactly how much they're buying because wasn't it Saudi Arabia and China that both got flagged by the IMF for not reporting what they were bringing in? And we see China buying doré and concentrate, which would not meet the 999 requirement that the IMF would need for reporting. These countries are doing everything they can to play the game along with the West, suppress the paper price, stand for delivery on cheaper stuff. They're playing the same game that we are, only against us. They're coordinated and they're motivated. And that's why there is such a low float in London, which I've been screaming about for years as it's been drawn down against a massive long position, 2 billion ounces, David Jensen, of deliverable contracts against 140 million ounces available. And who knows if that's even right? Or you can look at the guy's name is like Bruce Ikamoto, something to that extent. He's the head of the TOCOM in Japan. 3 million ounces a day London is trading in deliverable platinum contracts. He says there's no physical platinum available in London or Switzerland. None. Yet they're trading 3 million ounces a day of deliverable contracts. At some point, that has to piss off the world, the producers and the people who accumulate it and understand what it means. At some point, it just seems that the West will be challenged for the ability to continue to have their way with pricing commodities when price discovery is cast away through this type of shenanigans. And I think this is what is being used against us because these countries weren't coordinated or motivated and had no really intention of challenging the West. They do now, and they can do it by standing for delivery and using this silly, stupid hubris of controlling paper prices in the middle of the night with paper contracts and not the real thing, and use it against us by standing for delivery and accumulating everything on the cheap. So who knows who was behind it or what the ultimate motivation is, but I'll tell you this, very little of it, I believe, has anything to do with what the talking heads on Bloomberg or CNBC or Reuters will tell you was behind it. That I do believe.
So here's the question. If silver lease rates are 30%, India's refineries are empty, and central banks are buying physical metal, is this crash really the end, or the last big shakeout before the breakout? Andy Schectman's answer is crystal clear. You don't buy gold and silver to get rich. You buy them because they are wealth. He believes the Western paper pricing era is dying, and once the physical metal finishes moving east, no algorithm or ETF will be able to bring it back. If you trust real assets over promises, hit subscribe now. Comment below. Do you think this pullback is the final trap before silver breaks out, or the start of something bigger? Share this video with someone who still thinks gold and silver crashed for good, because the truth might be that the real bull run has only just begun.